Now, when it comes to the global economy, the word, of course, contagion. Fear of Europe's spreading debt crisis has taken hold. I want to look now at the effects on the U.S. economy and also investments with our guest, Steve Blitz. He is a senior economist at ITG Investment Research, and also with us, Douglas Borthwick, managing director and head of FX trading at Faros Trading. Douglas, I want to start with you. You have been bullish on the euro versus the U.S. dollar. You've made the point that we've got nothing really but negative news out of Europe for the past 40 days, and yet the euro seems to cling to this 134, 135 level and doesn't want to seem to sell off. What's been going on?
It's the Teflon euro. You can throw whatever you can at it, and it's not moving anywhere. Why? Well, there's terrific demand still from central banks around that 134.50 level, and they continue to have a strong interest in buying it. Remember, the euro is the only currency in the world right now that is not going into quantitative easing. What does that mean? Well, they're not printing euros. And that's quite exciting for reserve managers because they like to hold on to the wealth that they create and the wealth that they pick up. And so the euro, amongst all other currencies right now, is actually one of the better looking ones. What's also interesting over the past week is you've seen oil move up above $100. Above $100, the Middle East starts getting involved and starts calling around the banks and buying euros as well quite aggressively. So it's very hard to get through the wall of central bank bids that are sitting there right now, given what's happening. Now, you see yields move up in Spain, and you see them move around elsewhere. In our view, this is really a cat and mouse game being played by the ECB. If the ECB wants something to happen in a country, they can tweak the yields back and forth and then make sure that happens. What's happened this week? Well, Monti has passed. He got his confidence vote today, over 90%. Yesterday, you saw the same thing in Greece. It was 87% confidence in his government.
Right, the government of Lucas Papadimos in Greece and Mario Monti in Italy.
That's right. So you're seeing now these guys have great mandates to be able to enact the austerity plans that they are asked to enact by the ECB and the EU. And the reason they got there is because they gave them immense pressure. Immense pressure comes from playing around with the rates. Now, what does that mean for the super committee, let's say? Well, the super committee has no pressure. There's no pressure on the U.S. super committee to come up with a reason or an answer for why they could do any cuts. The stock market seems to be performing all right. The dollar seems to be doing okay. No one's really worried about the U.S. fixed income market. And so, in our mind, what's pressuring them to act? The last time you saw Congress really act was during TARP, and then you saw a huge collapse before they actually acted, and they acted in a moment of panic. Well, the ECB's taken that lesson, and they're using it really in Europe.
I want to press you on U.S. economic news in just a moment, but Steve Blitz, I want you to join the conversation having to do with the euro. Is what's good for Angela Merkel, what's good for Germany, good for the euro and not good for countries such as Spain and Italy? We had Jose Zapatero, the prime minister of Spain. He's facing an election later this week. His party is projected to lose, coming out and basically begging the European Central Bank and the European Union to come in and save Spain.
Well, what's good for Merkel and good for Germany is good for, they need a
It's good for the euro.
It's good for the euro. It's good. Here's the way to look at it in terms of flipping your question just a little bit in the other way. Germany knows what it needs to do in terms of loosening interest rates, in terms of, I think, letting the euro go down a little bit and basically putting some ease on the other side of the austerity that's coming into Greece, Italy, and Spain. They know that. But Merkel's kind of like a teenage parent, and it's sort of saying, okay, you can get the car back, but you can't promise to clean up the room. You actually have to clean the room before I give you the car. So that's the quid pro quo. We saw in the last week the ECB starting to buy some Italian bonds. So you're starting to see a little bit of a brinksmanship. There is a brinksmanship going on, and you're seeing basically the Germans saying, you take a step and we'll take a step, but they're doing it. It's a dangerous game because they're doing it against the timeline of deteriorating economic conditions.
They seem to be also doing a carrot and stick. I guess we can also use that description.
Absolutely, and I've used that.
We'll talk a little bit more. We've got Steve Blitz, senior economist, ITG Investment Research. Also with us, Douglas Borthwick, managing director and head of FX trading at Faros Trading. And joining us now, Bob Gelfond. He is the chairman and founder of MQS Asset Management. Bob, good to have you with us, joining the conversation. So what do you make of this comment today by Angela Merkel? Douglas Borthwick, during the break, says she comes out and she says you're not going to be using European Central Bank in order to backstop economies such as Italy. Not yet. You think it's coming?
I think the Germans are going to be very reluctant to go along with this because they know it's at best a short-term solution. Printing money essentially create the same type of situation that we have here. You're not going to solve any of the underlying problems in Europe. In fact, you're going to take some of the pressure off the Italian government, let's say, to make the reforms necessary if the ECB goes in there and starts buying their debt. It's not going to solve the problems.
Douglas Borthwick, does it really need to solve the problem? Can't it just buy them time until economic growth starts again in Europe?
It can buy them time. I think that QE for the ECB is just not an option. It's not really what they're thinking right now. I think that if the markets were to have some issues, then what you'd see is you see the Fed do QE 3, 4, whatever it is right now. But I think you'd see the Fed act rather than the ECB. The ECB really does want to keep this credibility. When Angela Merkel says we're not ready to do it yet, she's talking about December 9th when they're talking about treaty changes, where she wants to move forward the treaty change discussions to sooner rather than later. And with a treaty change, then that would mean that the ECB could lend to institutions internally or countries internally, which right now it can't because of the treaty. Now, there's also discussion today about the ECB lending money to the IMF and the IMF then lending money to individual countries. So, there's always a workaround. But the ECB decides not to use it right now because, why would you do something before someone's agreed to do something?
Steve,
it's all about pressure.
You notice that Douglas Borthwick says, unlike the American central bank, like the Federal Reserve, talk about quantitative easing. Based on what you're looking at in terms of the U.S. economy, do we really need more quantitative easing?
No.
I thought the economy's 2.5%, 2.5% growth in the previous quarter. And housing, take a look at the housing market. You've done some research there.
Yes, I have. And from my perspective, the housing market is basing and multifamily is growing. I think the single-family housing market, the data that we show in terms of people showing up to look for houses, inventory, et cetera, the new housing market is probably set up to grow a little bit next year, maybe add 100,000 new starts above this year's rate.
So what are we talking about, 400,000, 500,000 annual rate for next year?
Yeah, more like 500,000 on single-family. But the real story in the housing market is multifamily. And multifamily has already gone up. If you look in the South and the West, multifamily construction is almost up to where it was pre-recession, and that's a trend that's going to continue, and it's going to continue because we don't have enough multifamily. We underbuilt multifamily houses in the last 15 years, first of all. Second of all, the renters got turned into traditional renters got turned into buyers in the last decade, and that kind of financing is not available to them. Households are still being formed. It's supply and demand, and you see it in the CPI for rent. And in a free market like we have, prices are a signal for the allocation of resources, and the allocation says build rental housing.
Bob Gelfond, what about the idea that the U.S. economy might actually be in better shape than many people estimate?
I think the U.S. economy is doing okay. It's not going gangbusters, and I don't think that's in the cards anytime soon. We still have a tremendous amount of structural issues that we have to address. At the
Initial unemployment claims today, 388, right? That was lower, below that 400,000 level?
What I was going to say, though, is that there's no doubt that businesses left to their own design, the economy left to its own forces, will grow over time. It's able to withstand a lot of insults thrown at it by government policy, Fed policy, what have you. But that is a tendency, is that the economy should grow and just not grow as fast as it should be at this point coming out of a recession.
Douglas Borthwick, don't foreign exchange traders recognize that the U.S. economy is healthier than many people estimate? I mean, or no?
I don't think we do. I think we're a little more more skeptical about many things.
About this whole thing, don't you?
Further QE, in my mind, wouldn't come because of something in the domestic economy. It really comes from a stronger dollar is not going to help the U.S. stock market and not going to help U.S. exports in any way whatsoever. In fact, the Fed today came out and talked about how they would come in if there was further distress in Europe. Well, further distress in Europe would mean the euro selling off, and so I see the Fed's QE whatever as being a backstop for Europe on the downside.
Europe distress, I mean, couldn't that also be lack of dollar funding for European banks, for customers that are borrowing in dollars?
Certainly it could be. You could see a relaxation of the interest rate that has to be charged and that sort of thing by the Fed. But our reading of this is that, look, Obama said at the start of November of 2010, he wants to double U.S. exports in 5 years. That's not going to happen if the euro trades to 125. It will happen if the euro trades back up to 160. How can the euro go to 160 if there's difficulties in Europe? Well, the fastest way to do it, well, I guess there's two ways. One, China could immediately start fixing lower. The second would be that the U.S. enters into another form of QE.
Steve Blitz, do we have a confrontation here? Because I thought that bond yields, if you take a look at the 10-year, it's below 2%. The 30-year, I believe, below 3% today. If the economy in the United States is starting to grow and show greater signs of life, you'd think that bond yields, they wouldn't necessarily, they would reflect that, wouldn't they?
We've got a long way to go. There are a lot of structural problems. 2.5% growth doesn't push against any kind of constraints, doesn't really begin to get you down to the point where you start worrying about interest rates going up. And the last part of that is what the Fed's concerned about is financial contagion coming from Europe. We've seen this before. We've seen this movie before in the United States a few years ago. And the idea that if one bank or a few banks in Europe start to blow up, that's isolated and it's not going to impact here. It is. They're already foaming the runways, getting ready, the Fed and the Treasury, for that to happen. And people are scared, and rightfully so. What the issues in Europe, as far as the United States are concerned, the first impact is financial, through the financial system, not the real goods sector.
All right, we're going to continue the Gelfond. We've got an election coming up in Spain. It's probably going to be a new government. The opposition, at least according to the poll, is going to get in, become the head of the government. But then today, Jose Zapatero, the prime minister, basically begging the European Central Bank and the European Union to come in and save Spain. What other country is on the list, perhaps, for problems?
Well, I think, the big country everyone's worried about next is France, of course. They're really could be a really potential.
Why
huge
France?
problem.
Is it because of the banking system in France? Because of the collateral that the banks hold?
It's the same. It's really the same story, more or less, in all these countries. They have too much domestic spending. They have too many rigidities in their labor market. Their pension systems are overly generous. They have put too much support into the banking system. You have to get to a point where you're willing to allow failing companies to actually fail. And it's the same story all over, to different varying degrees all over Europe.
Douglas Borthwick, letting banks fail in Europe. Aren't we going to get some stress tests in Europe on the banks, or is that not going to happen?
This is the stress test.
This is the stress test. Live. You're doing live stress tests every day.
It's a live testing. And some banks will make it and some won't. And what's interesting is after the ones that don't make it, don't survive or get sucked up into the national economies, then you'll find that, I guess the U.S. mistake was, instead of letting these shareholders take the loss before they gave them the money, they gave the money and the shareholders made some gains. And what Europe, the way that they're looking at it is, well, let's see how far we can make these guys, the shareholders, take a loss before we put money in, which is why you're seeing a scramble now from French banks, German banks, banks in Spain.
Greek banks, for example, they were meeting at Deutsche Bank headquarters today to talk about write-downs on the debt of Greece.
Well, they're talking about write-downs. They're talking about bringing assets back, selling assets they don't need. Because if your price is down here, but your book value theoretically is up here, well, let's sell some of the book value so that the stock price can go up before the government puts money into our throats. And that's what we're seeing now throughout all of Europe. I think that the ECB, and when it comes down to recapitalizing banks, they want the shareholders to take a loss before they recapitalize them.
Steve Blitz, the idea that shareholders would take a loss, is that because the shareholder culture in Europe is so much different than it is in the United States? There isn't that much of intense pressure on politicians by owners of the banks in order to help them out?
You've done your homework, Pimm. You're absolutely right. It's a very different culture. Most of the shares that banks own shares in other corporations, it's a very, very
cross holdings a lot of times.
Absolutely, absolutely. It's a very, very different system than they have here. Here we're more of a shareholder and less of a bondholder culture, and there it's the flip side. So that's why bonds hurt a lot more to the population. And most of these governments that are coming in, they're trying to do the right thing in terms of what the ECB wants and what Germany wants.
You sound a little skeptical here.
Well, I'm skeptical from the perspective that everybody has a honeymoon. Obama had a great honeymoon, too, for a while, and they'll have a honeymoon. But when unemployment starts going very, very high in these countries and they start to implode.
Unemployment in Spain is already over 20%. Youth unemployment in the UK, we were reporting, is over 21% right now.
And there's nothing that says it can't go higher. And the biggest issue in Spain is that they haven't seen their real estate prices come down to the extent they have in the U.S., and that's going to impact all their small local banks. And so we haven't even begun to see that. So, we're in this little bit of a honeymoon right now. That's, I think, is a bit of a short-term armistice in Europe. Things will quiet down a little bit for a short amount of time. And then the 24/7 news cycle is going to go to the super committee, and that's going to be, all day, all night, and that's what everyone's going to be talking about. And as we said before, nothing much is going to come out of that anyway.
Bob Gelfond, when did the guests at the wedding party start to look over the silver, after the divorce? I mean, because, according to Steve and Douglas, there might be some assets to be had in Europe. How long do you wait to start picking over those?
It's hard to say. I mean, if you're looking for cheapness, things can always get cheaper. So you want to buy things as they become attractive, but not go all in. And, in terms of assets, one of the things that would actually help Europe is the divestiture from the government's privatization of assets. These things will actually help their economies, and not be the sort of austerity that people talk about that really hurts growth. They need to generate growth, same as we need to do here.
All right, I want to thank you, gentlemen, very much. Bob Gelfond joining us from MQS, Steve Blitz from ITG, and Douglas Borthwick joining us from Faros Trading.